I just met with two Wall Street insiders, and what they were discussing was absolutely terrifying. Now, most of the conversation was confidential, of course, but I want to try to reveal the main talking points so you, the viewer, can actually prepare for what could be a $52 trillion financial time bomb that is set to explode. I'm going to go over all of this, or as much of it as I can, in three simple, fast steps. Step number one, let's go over, everyone knows this chart, S&P 500, and ask the question, why? Let me show what I'm referring to. We have a chart going all the way back to the GFC to today's date. On the left, we go from 1,000 up to 4,000. Should probably go up to 6,000. I think that's the level, or close to it, where we are right now. And you guys know this chart. I'm sure you've seen it a million times. It basically goes straight up, with the exception of 2018, the cerveza sickness, and a bit there in 2020. But the bottom line is, if you were to buy the dip and buy and hold, you would have done extremely well. Now, what's interesting is if you ask the retail investor why this happened, they'll assume that the value of the underlying companies increased. But that's not necessarily true. So this takes us straight into the first topic of discussion, and this was passive versus active. So it's their view that this move that we saw in the S&P 500 all-time highs, which really doesn't make sense. And I'm sure a lot of you can resonate with this. You're like, well, wait a minute. When I look at the fundamentals, the PE ratios, I don't know what is going on. It just seems like we're in a massive bubble, but the bubble just keeps getting bigger and bigger and bigger. How can this possibly be true? I know that this doesn't end well, but I would have thought that it would have ended here, or ended here, or ended here. So that sense of frustration that just nothing makes sense anymore is something that I'm sure a lot of you can sympathize with. And their view, the Wall Street insiders, is that it has everything to do with the majority of the market not even looking at the fundamentals. They're not doing an analysis. Why? Because we have had this rotation of capital going from active management into passive management. So let's think this through. If you're someone that has a 401k, you have a normal job, you say, okay, I made $1,000. Every single month, I'm going to allocate $10 to the 401k, and that's usually going into an S&P index fund because people just want exposure to the stock market because they think that's the easiest way to retire, and they want to do that in the cheapest way possible. So there's this narrative out there where all you have to do is buy the dip, you have to buy and hold, and it's not timing the market, it's time in the market. So if you just do this at the lowest cost possible, then that's the smart, prudent thing to do. And what that does is it changes the mechanics of the underlying market completely. So we go from this market, and these aren't exact numbers, just doing a thought experiment here. So we go from the capital going into the market from 50% active, 50% passive, down to, let's just say for the sake of the thought experiment, we go into 100% passive. So that means that 100% of the capital going into the market is completely non-discretionary. They're not doing an analysis. They don't care about the underlying fundamentals. They just want to put $1 in, and they want that passive fund manager to just buy $1 of the S&P 500 in the cheapest way possible. Now, what this has done is this has also changed the psychology of the marketplace. So it's not just about, well, I'm not going to do an analysis, but then people actually rationalize their decision making, even though the stock market is at nosebleed levels, even though at every single metric it's overvalued. They tell themselves they're doing the smart thing because they no longer see the value and then assume that the price should somehow correlate to the value of the underlying asset. They just simply look at the price and assume that the price equals value. So if the prices are going up, well, then the value also has to go up. And therefore, again, they're rationalizing this, and this is how they convince themselves they're making good decisions by doing no analysis whatsoever, because they think the only analysis they need is just simply the price. But this is like looking at, well, this pen, let's say, and let's assume for a moment the price is $1, and the price goes up to $100, and then it goes up to $1,000. And then I tried to convince you that the reason the price of this pen went up to $1,000 from $1 is because the value increased. You'd look at me like I was absolutely crazy. You would say, absolutely not, George, unless this is somehow turned into gold or turned into some cure for stupidity. There's no way the value went up, because it still does the exact same thing. It still just has a cap, and you can use it to write on a whiteboard. And that value is worth $1. It ain't worth $1,000. So when we look at a simple example, of course it's crystal clear. But for some reason, when you replace this pen with the S&P 500, then it gets completely flipped on its head. So now the question becomes, okay, George, I get what you're saying. I get the mechanics behind passive versus active, but how big of a problem is this? Well, editor, go ahead and throw up a chart, and you can see the amount of money or capital going into passive management has gone straight up, and the amount going into active has gone straight down. So we might not be at 100% like our thought experiment, but we're getting closer and closer and closer to the point where there is no fundamental analysis whatsoever. There is no analysis of what the true value of the S&P 500 actually is. So why is this a problem? Why is this a $52 trillion time bomb? And by the way, the market cap of the S&P 500, 52 trillion. And here's the reason. Because you have indiscriminate buyers, you would also have indiscriminate sellers. So if they're not doing an analysis on the way up, they ain't going to do an analysis on the way down. So now it's not about value, it's more so about things like demographics. So as an example, if you have more people leaving the workforce, let's say the baby boomers are retiring, and fewer people in the workforce, you're going to have net outflows from these passive funds. And if you have net outflows into the passive funds, then the price is going to go straight down. But this creates a doom loop. Why is that? Because if you get this big move down and a sustained move down, let's say a bear market that lasts more than, I don't know, a week, then the retail investor, because they've been so conditioned to believe that the price action is value, they think the value of the underlying asset is going down as well. And then more people pull out of those passive funds and the net outflows increase. Now, usually you would say, well, they're going to buy the dip, and if the fundamentals get to a certain level, then there's going to be a bid. But that's if you're doing an analysis. That's if the active investors were really a big part of the market. So as the active investor gets squeezed out of the market, then the people that are basically doing a fundamental analysis, the people that are going to come in and buy the dip when the fundamentals make sense, are no longer there, and then you just get more selling. Now, why is this important? Maybe you're not invested in the stock market. Maybe you just got your house and that's the entirety of your net worth. You say, George, I could care less if the S&P 500 goes down 30, 40%. We've seen that before. It isn't that big of a deal. Well, I would encourage you to think through how the stock market now actually impacts the economy. And most of you would know from watching my videos that I would argue the stock market and the housing market, asset prices, are really propping up the U.S. economy. When you would like it to be all about productivity, producing goods and services, the real economy, unfortunately, it's been flipped on its head, kind of like this, to where the real economy doesn't really impact asset prices, but I can assure you, asset prices definitely impact the real economy. So once you understand the mechanics at play and why we're at all-time highs, the next question becomes, okay, well, how would this change? How would we go from net inflows with non-discretionary buyers to net outflows and possibly get basically an air pocket in the stock market that could take it down by 20, 30, 40% in a very short period of time? We talked about demographics before, but there's another contributing factor that is far, far more important, and we're going to discuss that right now. Step number 2. Now we're going to get into the tipping point that I was talking about before. We're going to go straight to an article called The Paradox of Passive Investing. And this is from 2017, but it is just as true and applicable, probably more so today. It's by a guy named Greg Cooper. He really echoes what I was saying in step number 1. When stocks are being purchased without any thought of underlying fundamentals of the company, this could create risk, that's an understatement, to how markets operate. There's clearly a benefit of low management costs that accrue to those using passive strategies. However, at what point are the benefits of low management costs outweighed by the causative effects of very large flows of capital being allocated with no reference to economic return? Or I would say no reference to the underlying fundamental. Is there a paradox of passive so that investors have low management costs, but in aggregate, lower returns, or the focus here, a lot higher risk? As more capital is invested with no thought behind what is being purchased, there has to be a tipping point where this irrational behavior is no longer sustainable. When is that tipping point? This is really the $52 trillion question, and maybe more when you look at the impacts on the overall economy. And it was the focus of this meeting I had with these Wall Street insiders. So the main takeaway is it's really not about demographics, although that's most obvious. It's really about the labor market and unemployment. Let's go straight to a chart of unemployment here in the United States. I want to go back to the GFC right around 2009, where the unemployment rate got up to 10%. But then what did it do as the stock market from the lows just went higher and higher and higher and higher? Well, as you would assume, the unemployment rate went down. That means more people working, more people contributing to their 401k, more dollars going into the S&P index funds. Now, obviously, it spiked up to, call it 15% or so during the cerveza sickness, but there were so many stimmies, there was so much debt forgiveness, or you didn't have to pay your student loan, you didn't have to pay your rent, you didn't have to pay your mortgage. So all of this money went where? Right into passive, and it went into passive strategies, the S&P index funds, and that's what just drives it higher and higher and higher. And by the way, that's one of the reasons why the S&P isn't just at nosebleed levels. The S&P 500 has turned into the S&P 7, the Mag 7, that the stock market is becoming more and more and more and more concentrated, which is a direct result of every single dollar, or almost every single dollar, that's going into the market going directly into a passive fund. Now, more recently, the unemployment rate has ticked up, let's say since 2023, but historically, we're still at very, very low levels, which means we haven't yet hit that tipping point where there's not enough dollars going in from people's paychecks to compensate for the dollars going out with people who are now on unemployment, let's say. So they need money to just sustain their standard of living, or those baby boomers retiring, the demographics that we talked about earlier. And this doesn't even include a recession. If we go into a recession, an economic downturn, then there's going to be even more of an incentive for people to put fewer dollars in. or maybe incentive isn't really the right way to look at it. It's the simple fact that they don't have the ability to put any more money into the market. And the only thing they do, just as a necessity, is take that money out of the market, which leads you into that air pocket. And oh, by the way, the doom loop, because so many people have been conditioned that the price equals the value, the average retail investor would assume the value of the underlying assets are deteriorating rapidly, and then you have less of an incentive to put those dollars in. So then the question becomes, okay, well, what on earth outside of a recession would make the unemployment rate spike up to a level that would lead to net outflows from passive investing? And oh, by the way, where is that level? Well, here is where I can give you some pretty detailed information. Based on one of the individuals, one of the insiders I was talking to, he said that he's actually modeled this out. And if his models are correct, he thinks the tipping point for the unemployment rate would be somewhere between 5 and 6%. In other words, if the unemployment rate gets up to, let's say, 5.5%, you are then going to see net outflows from passive investing. If you get net outflows from the S&P 500, you guys know what that equals. That equals the $52 trillion time bomb basically exploding. So then I know a lot of you right about now are saying, okay, George, well, even if that's true, it's never going to happen, because if the unemployment rate gets up to 5%, then the Fed is just going to come in, they're going to drop rates, the government's going to spend all this money, and the unemployment rate will never, ever, ever, ever go above 5% again. Therefore, we have nothing to worry about. I don't know. First and foremost, let's go back to the chart of the unemployment rate and look at history. And we can see that if we just draw a line straight across, well, actually, this chart does have a line, so that's good, at 5% throughout U.S. history going back to 1950, at many, 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 many times. In fact, I would say probably the majority of the time, just eyeballing this, the unemployment rate in the United States is, in fact, above 5%. But here is the black swan that I discussed with these Wall Street insiders. It was all about artificial intelligence. And both of them believe that AI is definitely the future. They believe that NVIDIA is way ahead, way overpriced, but at some point in time, it'll be like the dot-com bubble. But they believe that in the next 2 years, AI could bump the unemployment rate, all else being equal, could take the unemployment rate up to 8, 9, 10%. That's within the next 2 or 3 years. So note, I said they believe AI, because the loss of jobs, the lack of hiring, could take the unemployment rate up to 10%. Not 5%, 10%. And remember, 5% is the tipping point. Now, if you say to yourself, oh, George, well, these are just Wall Street insider guys. What do they know about the actual unemployment rate due to artificial intelligence? Well, good point. Let's go right over to another article I just read. And it's got some quotes or some predictions from people that are actually in the AI space. So right here, this is the Anthropic CEO. And in 2025, he came out and said that AI could eliminate 50% of all entry-level white-collar jobs. So the white-collar jobs implies making more money, which would be more dollars going into the 401k, which means more dollars going into passive. And we could see this type of job destruction within the next 5 years, potentially pushing the U.S. unemployment rate to 10 to 20%. That's in the next 5 years. So you would assume that in the next 2 to 3 years that we could see the unemployment rate go way, way north of the tipping point. And here's Kao-Fu Lee, I guess venture capitalist, 2025. They're in the AI space as well. They said that AI could displace 50% of jobs by 2027. And by the way, that's not entry-level jobs. That's 50% of jobs in the next 2 years. So I know that we'll likely come out with UBI or whatever it is from the government, but in the interim, from A
to be from where we are now to where we are in 2027, if even 25% of these jobs get cut, then that's going to take us past the tipping point, and that's going to lead to an environment where it would be highly probable that we see one of these huge air pockets in the S&P 500.
Step number 3. So how low can the S&P 500 go if this $52 trillion time bomb actually does explode? Well, before we get into that, I want to make something very, very clear. This entire video is not a prediction. I'm not predicting the stock market is going to crash. I'm simply trying to get you guys aware of risks that you otherwise might not be aware of. Why? Because when you see these Wall Street insiders talk on TV, they're never, ever, ever going to tell you the entire truth. They're going to tell you what they want you to hear. And it's only when you get behind closed doors, and fortunately, I'm privy to a lot of these types of conversations. So I'm just trying to make you guys aware of the risks that a lot of insiders on Wall Street are actually talking about. So again, this is not a prediction. So why should you be aware of these types of risks to begin with? Well, a lot of people have black or white thinking. They see the world in binary terms. In other words, they say to themselves, well, there's either risk in the market and therefore I should be short, or there's no risk in the market and I should be long. And this is very, very poor thinking. As Jim Rogers, my favorite investor, always says, this is the quick way to the poorhouse. So it's not just poor in the terms of weak thinking, it's actually poor in terms of this type of thinking can actually, or likely will, make you poor over the long run. So don't do this is the main takeaway. In fact, these two Wall Street insiders that I was talking to, both of them have long positions in the stock market. I don't know if they're long the S&P 500, but they absolutely have long positions. So they're just taking this information and they're using it to manage the risk in their portfolio. They're putting on what they call tail risk hedges. We'll save that for a topic of a completely separate video. Another big thinking mistake I see people make is they bury their head in the sand like an ostrich and just hope that everything will be okay. This is a very bad investment strategy. I also call it the ignorance is bliss investment strategy, where you're just hoping that everything is going to be fine. You just keep doing what you're doing. Now is not the time to do that. You have to use critical thinking. Okay, let's get to this chart. Start to today's date, we go all the way back to 2020. On the left, we go from 3,500 up to 6,500. This is the S&P 500. Okay, so why is this important if we're trying to think about how low the market can actually go? Well, we have to first start by doing the opposite of what most people do that we talked about in step number 1. We actually have to look at the fundamentals and look at the valuations. Editor, go ahead and throw up a chart of the PE ratios in the S&P 500, and we can see that they are very elevated. Now, they're not at all-time highs, but they're elevated. The key line in the sand I want you to focus on is 20. So now let's come back to the whiteboard, and like I said in step number 1, if you go back over the last 9 decades, so going all the way back 1930 to 2020, there were 4 decades where the S&P 500, when you adjust for inflation, went up. This was the 1950s, 1980s, 1990s, and 2010s. Well, if we look at the valuations at the beginning of these decades expressed in the PE ratio, every single decade it was under 20. So editor, go ahead and zoom in on where we were starting this decade of the 2020s, and you can see the PE ratios were over 20. Whoa, time out. I also want to highlight the fact that in addition to these 4 decades where the S&P finished higher, the PE ratios started under 20, there was only 1 decade where the PE ratios started off over 20. And that, of course, was the 2000s, and that decade ended with the S&P a heck of a lot lower than where it started. So there are no certainties, there are only probabilities. But if we do see the market continue to go down over the next 5 years, even after, let's say it hits an air gap due to this passive active dynamic, artificial intelligence, unemployment that we've been talking about, my guess would be you finish the decade lower adjusted for inflation than where you started. And we started the decade right around, we'll call it 4,000 on the S&P 500. So if I had to make a bet, I would say by 2030, we'll probably be lower than we were at the beginning of the decade, meaning right around the cerveza sickness lows. But I know that doesn't specifically answer the question as to how low the S&P 500 could go if we do hit this tipping point due to a recession, unemployment going up, artificial intelligence, etc. So this just gives me kind of a proxy as to where things should be, especially when you look at the PE ratios being, let's just say 18, 16, 17, 18, right around there, which historically are kind of in the norm. But that takes the S&P 500 down over the long run. Short run, I have absolutely no idea. I can tell you what the insiders were saying, and they thought that this could cut the S&P 500 in half, 50%. In fact, unfortunately, that was the most optimistic view. But remember, this was not a prediction. This was just going over the tail risks that are in the market right now based on the mechanics. If you want to know what I'm doing in my own portfolio to hedge this type of tail risk, you can check out the investment community I have with my good friends Lynn Alden, Chris McIntosh, Brent Johnson, Patrick Sresna, and Jason Hartman, where we do our very best to help you navigate this insane world of overpriced assets, out of control central banks, and big governments. If you want to check it out, we'll put a link in the description below this video.